Hello viewers, we'll be going over gold futures. We'll be going over my trade idea of the week and how I developed that trade idea. So let's start off with the technical analysis. We're currently down 56 basis points on the 1-hour chart. We were near overbought RSI on Wednesday. We have now approached to negative MACD, and we see the 9 and 18 moving average starting to diverge onto the 50 moving average, this yellow line. If we expand that further onto the 4-hour chart, what we have here, we are resting along the 18 moving average, this purple line, but we did see a divergence on the 4-hour MACD, and we're still near overbought RSI. If we expand out further onto the daily chart, what we have here, we made all-time highs of $1,998, and we're still overbought on the RSI. We see no signs of the daily MACD diverging, so that is a positive sign. At the moment, we may see temporary sideways action momentarily. So for the trade idea of the week, I'll be using GLD, and the trade idea, if I'm making a position, I will be using, say, less than 1% of my portfolio, and for entry for GLD, I would enter a long position at around $179.20. That is around this low range, and that coincides with the 9-day moving average, this blue line, and a gap up between July 27th and July 27th and July 24th. So in order to have a healthy uptrend, we do want to fill in that gap. So that's my entry for a long position, and my target to sell it, that is around $188, and my stop loss for that long position is $176.33. On the other hand, if I want to take a short position, my entry will be around $191, which is above the all-time highs that we saw on Wednesday, so around this range right here. And my target to sell is $182, and we're fairly close to that level compared to where we're at right now. And my stop loss for my short position is $194. So how did I develop these trade ideas? They comes from the day-by-day probability model, where we have the range and bullish and bearish ratio. So it comes from this table right here. And as we progress to the 5th day, we have, say, a 50% chance for GLD to fall between 6%, -6% to -11%, and to the upside, a 50% chance for it to climb between 0 to 3%. And one thing to note, these probabilities has a small sample size, so it's not statistically significant, so do keep that in mind. So which one of these two models we should focus on? Ideally, if we take a look at the line graph, the one that is the best match to the current trend, which is the blue line, and the line overlapping it happens to be the best match. So right here we have our current trend, and the trend below is the one that we compared it to on the line graph above. This trend dates back to July 26 to September 7th, 2010. So let's begin comparing both the trends. So what we have is 1, 2, 3, 4 points. And on the trend in question, we also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are somewhat the same. The outcome and forecast should be fairly the same. So we have 1 day out. That will be a Friday, and 2 days out will be a Monday, and so on. So we have 3 days out, 4 days out, and 5 days out. So the model that we just examined was back in July 26 to September 7, 2010. Gold continued to climb higher. In that 5 days, it went up roughly around 1%. And if we head back to the day-by-day probability model, that coincides with this standard deviation of 50% chance between 0 to 3%. Let's examine closer on the technical performance. So let's compare the trend in the past with the trend in the present. So the difference between monthly high somewhat the same, difference between monthly lows somewhat the same, and a little bit of technical difference on the 10 simple moving average, and also a technical difference among the 20-day simple moving average as well. And we don't have a 50-day simple moving average because we're only examining a 30-day trend. And these models are available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.